Look, both SCHD and VTI are top-tier ETFs, but they do very different things. One's all about growing your wealth. The other, it might actually start paying you every quarter. Let's say you have $100,000 to invest. Now the big question is, where do you put it? Do you want steady income from dividends or long-term growth that compounds over time? That's exactly what we're going to explore today. Two of the most popular ETFs, SCHD and VTI, offer very different incomes, and the choice between them can shape your financial future in a big way. In this video, we'll break down both, with real numbers, zero fluff. We'll look at performance, dividends, risk, and even simulate a 30-year investment. So, by the end, you'll know exactly which one fits you better. Let's get into it. Chapter 1. ETF Overview. What are SCHD and VTI built for? Alright, let's start with the basics. What exactly are SCHD and VTI? And why do they matter so much to investors? First up, SCHD. That stands for the Schwab US Dividend Equity ETF. It holds around 100 large US companies, but not just companies. These are businesses with strong fundamentals, consistent earnings, and a solid track record of paying dividends. Think of names like Coca-Cola, Pepsi, Pfizer, and BlackRock. SCHD is all about quality and income. It's built to give you regular cash flow through dividends. And at the same time, it aims for long-term stability. Now let's look at VTI, the Vanguard Total Stock Market ETF. This one's huge. It holds over 3,600 stocks. From tiny startups to the biggest tech giants in the US, Apple, Microsoft, Nvidia, all inside. VTI gives you broad exposure. It doesn't focus on income, it focuses on growth. So, in short, SCHD pays you while you hold it. VTI grows with you over time. Chapter 2. Historical Performance Comparison. Okay, so how have these two ETFs actually done over time? Let's break it down with some real numbers and see how they've actually performed. Starting with the most recent year, SCHD returned around 8.88%. Not bad. But VTI came in stronger, about 21.47%. Why the big gap? Well, 2024 was a strong year for tech, and VTI is packed with tech stocks. But 1 year doesn't tell the full story. So let's zoom out. Over the past 5 years, SCHD has grown by about 45.7%. VTI around 79.6%. Again, VTI takes the lead. Now let's look at the 10-year performance. SCHD returned roughly 114%. VTI closer to 178%. So, historically, VTI has outperformed SCHD, especially in strong bull markets. That makes sense, right? Tech and growth stocks tend to fly when the market's hot, and VTI owns a lot of them. But hold on, these numbers only reflect price growth. We haven't included dividends yet, and that's a huge part of SCHD's value. So before jumping into conclusions, let's talk about those dividend payouts. You might be surprised at the difference. Chapter 3. Dividend Yield and Growth. SCHD is known for its dividend payouts. Right now, it offers a yield of around 4.11%. That means for every $100, you're getting about $4 a year just in cash flow. On the other hand, VTI, its yield is much lower, around 1.51%. So that's closer to $1.50 for every $100 invested. But here's where it gets more interesting. Let's look at dividend growth. Over time, SCHD has grown its dividend by about 11% per year. VTI's dividend growth is slower, around 7% annually. So not only does SCHD pay more, it also grows that income faster. And remember, these dividends come in quarterly, straight to your account. No need to sell any shares. That's a big deal if you're aiming for cash flow, especially in retirement or if you want to reinvest those payments. VTI, on the other hand, focuses more on companies that reinvest profits back into growth, which is great for long-term capital gains, but not so great if you're looking for income today. Alright, next up, let's look at how risky these ETFs really are. Chapter 4: Volatility, Risk, and Drawdowns. Because returns are great, but only if you can stomach the ride. So how bumpy is that ride with each ETF? Let's start with volatility. SCHD has a standard deviation of about 8.05%. That's a measure of how much its price moves up and down. VTI? It's a bit more jumpy, around 9.41%. So SCHD is the calmer one here. Not totally smooth, but definitely less shaky. Now, let's talk about drawdowns. That's how far the price has dropped during tough times. SCHD's worst drop was about negative 33%. But VTI? It fell over negative 55% at its lowest point. That's a big difference. Finally, let's look at risk-adjusted performance. This is where we bring in the Sharpe ratio. SCHD scores around negative 0.07. VTI is a bit lower, around negative 0.14. So what does all this mean? SCHD tends to be more stable. It doesn't soar as high, but it also doesn't crash as hard. VTI can grow more, but it comes with bigger swings. Chapter 5: Portfolio Composition Deep Dive. Let's now open the hood and see what these ETFs actually hold. Starting with SCHD, it's pretty selective, only about 100 stocks, and it leans heavily on value and dividend-paying companies. Right now, its top sectors are industrials, healthcare, and financials. Names like PepsiCo, Pfizer, Cisco, and Broadcom are in the top 10. These are companies that have solid profits, strong balance sheets, and a history of paying dividends. Also, SCHD has no exposure to small cap or speculative tech. It sticks with tried and true businesses, which explains its lower volatility. Now let's look at VTI. It holds over 3,600 stocks, basically the entire US market. So you get exposure to large cap, mid cap, and small cap companies. Top holdings include Apple, Microsoft, Nvidia, and Amazon. It's very tech heavy, especially in the large cap space. This makes VTI more diversified, but also more sensitive to big market swings. So if you want broad exposure and growth potential, VTI delivers that. But if you want a tighter focus on strong, income-generating companies, SCHD might be the better pick. Now, let's see how they stack up in a real-world, long-term investing scenario. Chapter 6: Long-Term Simulation, $100,000 over 30 years. What happens if you invest $100,000 today and just let it sit for 30 years? Let's start with VTI. Historically, it's averaged around 9.77% annual growth. So after 30 years, your $100,000 could grow to about $1.65 million. That's solid. And most of that is from price appreciation, not dividends. Now, what about SCHD? It grows a bit slower, closer to 7.77% annually based on past performance. That puts you around $940,000 after 30 years. But here's where it gets interesting: the dividends. If you reinvested SCHD's dividends along the way, your ending value could reach about $1.32 million. Still below VTI, but not by a huge margin. And remember, SCHD also builds up an income stream. At 4% yield and 11% growth, in 30 years, your SCHD portfolio could be throwing off around $31,000 per year in dividends. That's real, ongoing cash. No selling needed. VTI will likely be worth more, but SCHD can actually pay you to hold it in retirement. So it really depends on what you want: bigger pile of money or a steady stream of income. Let's wrap this up with a final decision framework. Chapter 7. Final thoughts: which one is right for you? So now the big question. Which ETF should you choose? Well, it really comes down to your goals. If you're young, have time on your side, and you're focused on long-term growth, then VTI gives you broad exposure and solid upside. You're investing in the full US economy, from tech giants to small caps, and that means more room for compounding over time. But if you want a portfolio that's less volatile, more stable, and one that actually pays you consistently, then SCHD might be the better fit. It won't grow as fast as VTI, but the dividend income is real and it grows. Also, think about your timeline. If you're near retirement, cash flow matters more. If you're in your 20s or 30s, growth might be the priority. And hey, there's no rule that says you can't own both. Some investors use SCHD for income and VTI for growth. It's all about balance and what fits your plan. So take a look at your goals, run the numbers, and make the ETF work for you. Thanks for watching, and as always, invest wisely.